Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein of Linn & Associates with your weekend edition of your metals market update, and this is for Friday, the 23rd of November, 2018, and welcome. Remember, on the weekend edition, unlike looking at daily charts, which is what most people trade off of, over the weekend I like to bring you in, let you see what the weekly charts look like so you get the bigger perspective of what is going on. So with that in mind, let's talk about the market. Gold finished off on Friday down $4, but it's been a story of the dollar. The dollar has been super strong. The stock market has been under assault. Energy prices have been under assault, and they continue. Look at Friday, down nearly $5 a barrel in Brent, 4.25 in the crude. Gasoline prices crashing away on you. So if you think that you have an inflation story, you don't. You've had more of a fear story as to what's going on in world economies than anything. When we go to the monthly bar chart of gold, and that's all that I'm looking at is the monthly bar chart here, you're caught in the sideways pattern that we've been in when you look at the monthly chart, honestly, since this break low in 2015 to this rally high through here, and you're just sort of meandering back and forth. From the most recent high to low, you've dropped about $200 an ounce. When we go to the weekly area chart of just closes, and that's what we're going to now focus on, you've gone from 1176.50 up to 1239.30, and off that high, you're only $16. You have upside bias because my definition of the word bias is where you in relation to the 18-week moving average of closes when you're on a weekly chart, and you're over it, which gives the market an upside bias. When I take a look at Fibonacci numbers, I'm going to come from the high up here near 1365 to 1161. There's that $200 break. This is a 38% retracement, 50%, 62%. So the market's been fighting at the 38% retracement. Nothing overly bullish there. Where you get friendly in the market is the weekly chart. When you just put on the swing line. You've got a pattern of higher lows and higher highs. We don't know where this high is going to end up yet, but that's what we have. What else do we see on the chart? We see, if we keep looking at the chart, that it's over the 18-week average, the bias is up, and the 200-week in this gray number right here, that's the resistance point, the first area of resistance. We've hit it 3 times back here. We backed away. Now you're coming up again. If you clear it, that resistance fades. You've hit it enough times to try to move through it. But while the 100-week average at 1264 is important, I always ask, where are these Bollinger Bands? And they are right here at the 1240 level. The importance of Bollinger Bands are this. There's a different look to them depending what the market has done. When you had sideways action here and you broke, you rode the band. Everything changed. The momentum changed and you kept riding the band. You're again in a consolidation phase right here. You have a bullish upside, but you've got 2 areas of resistance, 1233.40 and 1240.10. Where's the support? Back at the 18-week average at 1209.90. And what number would you not want to take out if you're going to keep that uptrend? Right here, 1196.60, that swing line low. In terms of momentum, you've run out of the upside punch, unfortunately. You're just drifting sideways as measured by the slow stochastic oscillator. I don't use the weekly oscillator the way that I do the daily. If you want to learn how I use these, you've got to go to my charting course, go to our website and go under the word education and look into that. That's where you learn about that. I just view this as now sideways action tying in with all this sideways action. The gold-silver ratio still does not favor the other metals coming to life and jumping on price of gold. In other words, getting stronger than gold. You're now at a new high on the gold-silver ratio. Frankly, I don't remember it ever being up this high, 85.79. That doesn't mean it didn't. I just don't recall it. I didn't do my research before I did this to see if it ever had. When you come to the GLD ETF, it's in an uptrend, higher lows, higher high. You've got upside bias. Momentum, just like in the other market, flat. I'm not saying it can't come alive. Your resistance is a 117.24. The support, 114.56, the 18-week average. And if you take out 113.42, all this good work could become a top, and you put back into play the possibility of getting to that lower Bollinger Band. When we come to GDX, if we take a look at this week's high, it's 119.92. So the high took out this high. This is the first good weekly action in a long time on GDX. It's not in a downtrend any longer. You have a higher high and a lower low. You have no trend. But you have upside bias because you did manage to close over that 18-week moving average of closes. And momentum is still pointing up, not what it's doing in the other markets. In the silver, the bigger picture is still bearish. You still have the lower highs, lower lows. The bias is down as you're under the 18-week average. Resistance, 1463, let's call it, where you'd get the bear's attention is getting over 1488. Yes, it would not give you, if that happened right now, you'd still have a lower low then and a higher high, so it wouldn't be bullish, but it would end this bearish consolidation phase that we had and that breakout to the downside. The copper market, with all the bad news that you keep hearing about, is still over the 18-week average of closes. It managed to close over it by about a penny and a half. It has had a trend that's up, higher lows, higher highs, unable to get up to the resistance of the 287 to 287.50 area, 87.35 to 50, and you're in danger here if you start down of momentum turning on you. Obviously, this market's going to be focused on one thing, as I see it, the G20 meeting. Are China and the U.S. going to talk, and how do they view that for the copper market? In the platinum market, the trend is still up, but there's divergence here. You have a market that's got higher lows, higher highs, that has hit its upside targets, the upper Bollinger Band, and failed miserably at them, coming back down. However, you've still kept the bull pattern because you got the higher highs, higher lows, and the bias is up. The divergence is that momentum, which often leads price, has turned down. So no, it doesn't rule the day. What would rule the day is taking out last week's low, and that low is 829. So if you take that out, you could end up very quickly with lower highs, lower low. Momentum is already turning down. If you closed under 823, the bears would take control of the market. In the palladium market, the market was down $69 for the week. Momentum is trying to turn down right now. See how the red line got under the blue? If it can get under that, we get a pullback. But you're so far over that 18-day average, I don't see the market just coming down like that. I can see a correction, but I still think that the bias will stay up in this market because to get to that number, $70 away, it's quite a move. This was an all-time high last week. What else do you see? That was an outside week up. You took that out. You took out the low of the outside week up. When that occurs, often, it is not the word always, often, price and the 18-week average try to get together. So that's what I think is working on in this market, and I think the momentum is telling you that. In the dollar index, we still have the patterns of higher lows, higher highs. You hit the Bollinger Bands, you back away, you hit them, you back away. That's the pattern we have. And obviously what's winning the day for the dollar is the strength of the U.S. economy compared to other economies, and the fact that here we are looking at putting on another interest rate hike in December, and the best we're hoping out of the European Union is they'll stop their bond buying, and we're not seeing other countries, because of the weakness that they're getting in their economies with these trade wars, wanting to join the party of raising interest rates. Their central banks want to, but the economic data is preventing in many of those developed countries doing that. Undeveloped, I don't care about. And that seems to be the story that's going on and puts the dollar all by itself as that strength. That's what you got to consider. One of the things I'd like you to consider is our research. Now, I'm saying I'd like you to take a look, if you're a metals trader, what we write about the metals, how we do it, what we're predicting, our special reports. And yes, daily we put out oral updates, not just me, I'm talking in our trading platforms about these metals. If you'd like a good handle on it, call our staff, go to our website. You'll take a look at our free offers. The word's free. Yeah, it's Thanksgiving weekend. Click here. If you're used to getting my research, you might want to take a look at what that costs. We have a Black Friday special just for new subscribers, and that's where it ends. I'm Ira Epstein. You have a great weekend. I'll see you all Monday.